Thanks for tuning in to Account is a Joke. I'm Dr. Who, and it's always my humble pleasure to add some fun in the fundamentals of accounting. Here on this platform, you don't need no boring textbooks or lame tutors as we chase the bags with this accounting information. Remember, gang, accounting ain't hard, it's really a joke, and I'm here to give you the punchline. Bags! Riddle me this, my fellow bag chasers. Suppose that we're an online retail merchandising company selling all the drip, all the swag, beautiful shoes such as these. Since we're a merchandising firm, we are purchasing those shoes from the manufacturer, then selling it to the end consumer. Remember, gang, only two things could occur with inventory. Either you sell it or you don't. So whenever we sell inventory, it is no longer an asset. We have to create an expense. Those units that were actually sold now reflects our expense, which is called cost of goods sold. Remember, cost of goods sold sits on the income statement and it helps us calculate gross profit. The units that we don't sell still are assets and they still lie on the books at cost based on ending inventory. Remember, ending inventory is an asset that belongs on the balance sheet. Are you picking up what I'm putting down yet? Suppose that throughout a period, we purchase 1,000 of these identical shoes at various prices, costing ranges of $300, $350, $200, $250. At the end of the period, we have 250 remaining. The million-dollar question is, of the 250 remaining, how much did they cost us in total? Remember, gang, we bought them at different prices. Likewise, of the 750 pairs that we sold, how much did those cost us as well? You see where the problem comes in that, gang? But don't fret. In this particular video, we're going to address how to assign cost to ending inventory and the cost of goods sold under the perpetual system with 4 particular inventory costing methods. Let's further ease the confusion with a visual example of an inventory list. Okay, gang, so we have here a brief period describing an inventory costing list. And basically this just shows the following transactions that took place in the month of January pertaining to our inventory. And so we have a series of columns that particularly pertain to the date, the type of transaction, how many units was affected, and the price. And so for January 1st, we started out the period beginning inventory with 20 units at $10 each. This is basically what we had from the previous period at the year end. So we made a purchase on the 12th of 5 units at $12 each, which is the cost of those units. We also had a sale on the 20th of 10 units that the selling price, which we sold it for, was $30. So this is your selling price. On the 24th, we had an additional purchase of 2 units that cost us $15. And lastly, on the 30th, we had another sale of 6 units with a selling price of $30. And so what we have to identify, again, at the end of the period is what's the cost of our remaining goods and what's the cost of the goods that we sold. So I want you to follow through. First and foremost, the units available for the period, how will we be able to calculate that, right? The units available for the entire month of January, obviously we started out with 20, we made a purchase of 5, and then we made an additional purchase of 2. So therefore, our total units available, beginning inventory plus all the purchases, is 27, gang, 27. And so next, we would have to find out how many units were sold, right? Clearly, in this particular month, we had 2 sale transactions. The one on the 20th was for 10, and the one on the 30th was for 6 units. Therefore, our units sold for the period is 16, gang. So we started out with 27, we sold 6. So we can conclude that our ending inventory, the units that we have remaining, is the difference between those two. So if we subtract 16 and a 27, we will get 11. So here's where the situation occurs, gang. We've sold 16 units, which will be represented as our cost of goods sold. But we have 11 units that will be represented left remaining as our ending inventory. And so what we have to do, if you pay attention, gang, we have 3 separate transactions in which the purchasing prices are totally different. We bought something at 10 initially, then we made another purchase of 12, and then we made another purchase of 15. So it's several different prices. So of the 11 that's left, what prices are they? That's what we're trying to find out. Likewise, of the 16 that we sold, what were the cost of them? What were the prices? Again, gang, we have 3 different prices that we have to consider. And so that's what the inventory costing methods do. They allow us to find out that particular problem. Method number 1, FIFO. FIFO is basically an acronym, gang, and it stands for first in, first out. So what it basically means is that the first batch of inventory that is coming into the business will always be the first set that is going out the business, being sold. And so what I want you to understand is, if we have a particular list, right? Assume that there's a list in my hand, and we are practicing FIFO, our cost of goods sold, our units that are being sold will always start from the top, gang. Why will they start from the top? Because the method dictates that the first thing coming in chronologically, which are always the things that's on the top of the list, will be the first to go out. So anytime we start accounting for the units that were sold, i.e. cost of goods sold, we will always start from the top of the list. What about ending inventory? Well, if we are selling from the top first, the first units coming in, then what we won't sell will always sit at the what? Bottom of the list. Does that make sense? How about we go back to another visualization of an inventory list? Okay, gang, so we're back to our initial inventory list, and now we're going to apply FIFO to be able to calculate our cost of goods sold and our cost of ending inventory. Now, based on our previous calculation, we sold 16 units. So gang, we're trying to find out of the various purchasing price, which we have 3, right? We have $10 each, we have 12, and we have 15. 3 different costs. Of those 3 different costs, we're trying to figure out, where did those units be sold? Those 16 units be sold. And we're practicing FIFO. And as our rule tells us, the first batch that came into the business will be the first batch to be sold. And so of this particular list, anytime you're practicing FIFO, you start from the top. Therefore, those 16 units that actually were sold during this period came out of beginning inventory. Beginning inventory, the 20 units at $10 each. Why? Because those were the first units that we had that came into the business. Likewise, gang, those 11 units remaining that we didn't sell, because we're practicing FIFO, they will sit at the bottom of the list. At the bottom of the list. So, we had 20 units, gang, at $10 each, but in total for the period, we only sold 16, right? So we still have 4 units remaining that we didn't sell out of beginning inventory. And so those ending inventory units of 11 comes from the 2 units at 15, the 5 units at 12, and the remaining 4 units out of beginning inventory. Method number 2, LIFO. So LIFO is actually the opposite in terms of the approach to FIFO, first in, first out. So with that being said, LIFO is also an acronym as well. And if you guessed it, LIFO means last in, first out. So what does it mean? The last batch of inventory that you purchase will be the first batch of inventory to be sold. So back to our inventory list, our chronological inventory list with purchases and sales. If we are practicing LIFO, our units that are being sold, i.e. cost of goods sold, will be reflected from the last purchases, which will start from the what? Bottom, gang. It will start from the bottom because it tells us that the last thing that we are purchasing is the first to go out. Likewise, if we're trying to account for the units we have left, which is ending inventory, those costs will be sitting at the what? Top of the list, because we're selling the last first. And so what we don't sell, we'll keep continuing to have at the top of the list. So if you understand FIFO, just reverse the ideology to approach the correct answer to LIFO. Let's look at an inventory list again. Okay, so this time we are assigning the cost of goods sold and the cost of ending inventory using the LIFO method, which tells us that the last thing purchased will be the first thing to be sold. Now, we're practicing the perpetual system of inventory, gang, and so we have to account for each sale individually. I'm not going to do any calculations here. I just want you to understand the methodology of the flow of how the inventory leaves when practicing these different methods. So, assume that we are on the 20th right now, January 20th, and we've sold 10 units. My question to you is, where will they come from first if we're practicing LIFO? Now, what I want you to focus in on, gang, is that because it's the 20th, the 24th nor the 30th did not occur. So this would entirely be the wrong answer, okay? Because we can't go into the future, gang. We are talking about the sale that occurred on the 20th. And so since we're practicing LIFO, what set of inventory would be sold first? And so you only have two choices: beginning inventory on the 1st or that purchase of 5 units on the 12th. And obviously, since we're practicing LIFO, the last thing out of those two choices must be the purchase on the 12th, the 5 units. That which will be sold first. And so if we was to move forward to the sale on the 30th, again, we sold 6 units on the sale. We are practicing LIFO, gang, and anytime you practice LIFO, it's always the last thing that came into the business. So when your cost of goods sold is being accounted for, you always start from the bottom, right? And so we're on the 30th now, and so what would be the first thing to be sold? Obviously, gang, the last purchase, which happened on the 24th. So you can see how LIFO differs from FIFO in terms of the flow of inventory. Now I'm going to produce some more videos that's going to do actual calculations, gang, but I just wanted you to focus in on the flow. Method number 3, specific identification. Specific identification, gang, in my opinion, is probably the easiest one of all 4 of the methods. Why is that? Because it will actually specifically identify what batches of units that are left and ending inventory and what batches of units that were sold in cost of goods sold. So it's no particular first in, first out, or last in, first out method that applies. You already know what units cost what. Most of the time, specific identification is used in very high-end exclusive goods that could easily be identified specifically at their cost. For example, consider us being a high-end exotic retail company, and we may only have 10 cars on the lot: a Bugatti, a Porsche, a Ferrari, a Mercedes, yada, yada, yada. At the end of the period, if we sold 4 cars, we can easily specifically identify, oh, we sold a Bugatti, I know how much that cost. Oh, we sold a Ferrari, I know how much that cost. Oh, we didn't sell a Porsche, I know how much that cost.
How much?
$62,581.43.
Get it? So specific identification from a practical sense is easily identifiable because the units are not identical. And last but not least, method number 4, average cost. This one's a doozy. A gangster, a monster, the final boss. In my opinion, I find that most people have complications with this one. But don't worry about it. I'm here to give you the punchline. Bang! Consider this. Consider you went to the store and you bought 2 pieces of candy. You bought a pack of Annihilators for 5 cents. Then you bought a pack of Jolly Ranchers for 15 cents. What's the average cost of those 2 pieces of candy? You can clearly identify that the average cost of those 2 pieces of candy is 10 cents. How did you get the 10 cents? You basically added up the total cost of the 2 pieces of candy and you divided it by the number of units, which happens to be 2. This very simplistic approach is how we identify our cost of goods sold and cost of ending inventory at any given time under the average cost. So we are simply identifying our cost based on the average cost of the goods that we have available at that time. So that wraps it up, gang. A proper introduction to the 4 costing methods for inventory. As always, gang, I appreciate the time that you share with me, and hopefully I'm helping you get closer to those bags. And if so, don't forget to like, subscribe, or share the channel with your friends so that they can chase the bags as well. Look forward to seeing you all on these examples for these particular methods. Until then, see you soon.